How to become a better growth stock investor. What is happening, investors? It is your boy Jack. I am not a financial advisor, and today we're going to be speaking about growth stock investing. In particular, I want to try and help you guys figure out what really goes into investing in growth stocks, what goes into the research, and what points are important to keep in mind. In my opinion, it needs to be treated very differently to dividend stock investing and also value investing. Growth stock investing in nature can be very high risk, and with that being said, there's a lot of points we need to keep in mind. We're going to speak about why being cash heavy is more important when you're a growth stock investor. We're going to speak about investing only in what you understand. We are going to speak about the timing of your growth stock investments and why it genuinely is quite important, just how much research it takes to find a good company and how much time it takes to keep up to date with everything that's happening in that company. And we're going to speak about the fact that you are going to make mistakes and that it is okay to sell stocks. There's a few more bits and pieces that will come up in between, but that's the main agenda for today's video. And the goal is that once you've watched this video till the end, you will be a more confident, well-rounded growth stock investor. So guys, with that being said, could I please ask you to hit that juicy like button? It really helps me in the channel out. I would appreciate you absolutely massively. If you're new around here, what are you waiting for, my friend? Please hit that juicy red subscribe button and join the family. We're trying to get to 50,000 subscribers. And drop me a comment down below. Let me know if this video helps you. And I'm also interested, what kind of investor are you personally? With that being said, my friends, into the video. So this first point is very much so an opinion, and I know a lot of people are going to have different opinions in regards to this one, but in particular when it comes to growth stock investing, I genuinely think it is very important to be cash heavy at all times. Why do I think it's so important in regards to growth stock investing in particular? Look, we're going to use Workhorse for a lot of our examples today because it's the company that a lot of you guys know me for the most, and it's the company that I have put the most time into. Simply put, if we have a look only on the monthly chart with Workhorse, we can see a 25% sell-off in the span of 2 days, and we can see another 16% sell-off in the span of 4 days. Growth stocks carry massive, and I mean truly massive, volatility, and you want to be able to take advantage of that volatility. Now we're going to get into research in growth stocks versus research in dividends or value plays, but if you've done the research into a growth stock, okay, you're going to understand from the start that a few things need to go right in order for you to make a whole lot of money. And sometimes the time frames are going to be wrong, or sometimes those things won't happen at all, and that is going to lead to a sell-off. With Workhorse, for example, this sell-off right here was part of a broader market and a broader EV market sell-off. Nothing to do with Workhorse. This sell-off right here was because we didn't get the contract by the end of the fiscal year, which a lot of people expected. So let's say, for example, you were somebody who was late to the party with Workhorse, but you did do all of the research and you really believe in this company and you think that, say, $25 to $30 a share was fair value for this company and you could make a lot of money. So you were one of the many people who bought in the 30s for this company. Within 2 days, you were down 25%. But you've done the research and you know that this sell-off isn't Workhorse's fault. Well, if you had gone all in, if you had built a full position right off the bat, you wouldn't have had the opportunity to buy more down here and overall bring that cost basis down. You would have been stuck looking at a 25% loss in the span of 2 days, and that is going to leave a sour taste in a new investor's mouth. I personally, as of right now, am pretty much at least 50% cash. Now that is more than cash heavy. In general, I think even having about 30% cash is absolutely fine, but it gives you the opportunity to buy on dips, okay? And that is very important when building a position in a growth stock. Workhorse, for example, with me, okay? It's a company who I bought initially in the 14s, okay? I also bought them in the 17s, and I also bought them in the 24s. Now, of course, the people who make the most money will be the ones who invest all in when they think it's at a good price. I mean, of course, if I had have put all of my money in at $14 a share, I'd be up more money than I am now. But they're also the people who stand to lose the most. If you go all in at 14 and say things don't go right and it goes all the way down to 7, you've lost all of your money. Whereas if you then proceed to dollar cost average and it goes back up, you're going to make more money than the initial investment would have. I mean, let me bring you to the monthly chart of one of the most well-known dividend stock that is out there, Johnson & Johnson. Look, we see this massive dip, but that massive dip was actually 3.3% on the monthly chart. That was the biggest dip we saw, and you can see that straight away again they went up pretty much to where they were. So I don't think it's as important to be cash heavy in dividend stocks, because in general you're not going to see the biggest swings outside of, you know, massive worldwide events happening such as the Roni. So I don't think you need that much cash with dividend plays. I'd be fine being, you know, maybe 15-20% cash if I was a dividend investor. But when it comes to growth stocks, the confidence you're going to feel from having that much cash on the side is very important. And it also means that when things go wrong, you can load up on that stock. When this crash here happened, when Workhorse went from $30 $20 to $22, I bought 80 more shares at 24. I already had 220 shares. That same week, the whole market was downtrending. I put $5,700 into the market because I was cash heavy. This week I didn't buy anything because, you know, there wasn't a big enough sell-off to justify me buying a whole lot. So that's the first point, just be cash heavy. Now the next thing I want to speak about, okay, is with growth stocks, do not invest in what you don't understand. To me, this is specifically true for growth stocks. I mean, with dividend stocks, who really cares? I mean, let's speak about Pepsi, okay, another very popular dividend stocks. And if you go to the max stock chart, if you hold this company for long enough, you know, you're making money. You don't need to know Pepsi inside out. You're going to make a decent bit of money every few years if you're willing to hold them for a long enough period of time. You don't need to know every single one of their competitors. You don't need to know every single one of their competitive advantages. It's a relatively safe dividend stock at the end of the day, people. Whereas yet again, with a company like Workhorse, okay, you need to know this company inside out. You need to not only understand Workhorse, but you need to understand the electric vehicle industry as a whole. You don't only need to understand the electric vehicle industry, you need to understand the last mile electric vehicle industry. You literally need to understand everything. You need to understand, why are you investing in Workhorse over Nikola or over Tesla or over Rivian if they are to go public? You need to not only know Workhorse, you need to know the competition. Whereas with a dividend stock, Pepsi, I mean, yeah, you can just look at their balance sheets, you can look at their 10Qs, etc. You're going to get a decent understanding of whether or not they're an okay company. You don't need to know them absolutely inside out. Very rarely are they going to see massive drops, and I mean, literally every time in history that has happened, they've gone up to new all-time highs. Another extremely popular dividend stock, ExxonMobil, okay? A lot of people like investing in these guys. They have a very nice dividend. They have a long history of paying that dividend. I guarantee you right now, there are so many people investing in this company who know very little about the world of oil. They might not even know what ExxonMobil does right now. Are they upstream? Are they midstream? I mean, who knows? They have a 10% dividend, I'll invest in them. And funnily enough, for a dividend investor, that will work out an awful lot of the time. With a growth stock investor, that won't, and here is why. If something big happens in the industry, if a breakthrough happens, or if on the other side of things, you know, we get pushed back, that's going to affect the entire industry at a drastic scale. Here's a stock I missed out on. Fastly. So I mean, I was thinking about buying these guys a long time ago. I don't know exactly when. It probably was around June. And you know, they've gone up over 100% since. That would have been a fantastic investment. And I expected them to go up. But I do not know enough about the industry. I don't know cloud computing inside out. I know the basics. I have a general understanding of it. But if I was to be interviewed by someone and they started asking me about cloud computing service providers, I would look like an idiot. Because I don't know very much, in all honesty. I know the basics. I know what a few hours of research would tell you. When it comes to EV, I could hold my own in an interview scenario, you know? I mean, I've interviewed the CEO of Lordstown Motors, the CFO of Workhorse. You have to know a little bit about an industry to do that. But that should just show you guys why it's so important to really know what you're investing in growth stocks in comparison to dividend stocks. It's not as important with dividend stocks, in my opinion. Now, the next thing I want to speak about is timing. Because again, with dividend stocks, I don't think it's all that important. A lot of people literally set up DRIP, you know, dividend reinvestments. They don't even look at their portfolio for years. It just keeps going in every week or every month, however you set it up. Because that's dollar cost averaging, that's how dividend stocks work. But I want to speak about growth stocks because honestly, timing is very important with growth stocks. So we're going to take a step away from Workhorse and we're going to go to HYLN, another stock everybody's going to be aware of. If we go to the 6-month chart, we can see absolutely everything that's happened with this company. HYLN, now this was all the way back in the 29th of June. I had a lot less invested back then, okay? But you can see on the screen right now, I bought 6 shares of HYLN at $30.30 a share. I mean, they got me right at the top, right before this sell-off happened, okay? We lost 43% in value, my friends. That was terrible timing on my part. Now, thankfully, it was a tiny position. But the thing is, I had done my research into the company, okay? I had put a lot of hours into looking into them, and I thought to myself, I was like, no, I believe in this company. I really do. So I held, and what I did was, I bought them on 3 more occasions, okay? And all of those times were between $18 and $19 a share. And now I have a cost basis of $20.98 a share. And there was a stage where I was up about 175% in this company, after initially buying at the worst possible time. There's a very clear example of why being cash heavy and dollar cost averaging is so important. I was able to just hold through all of this. I'm still up a relatively nice amount, close to 100%. If I had just bought in once, right now I'd be up about 24% instead of 100% more or less. So this was an example of me being poor at timing the market. Let me show you one of where I timed it really well. Because I like to get in early to have room to dollar cost average, regardless of whether it's down or up. Lordstown Motors, okay? Not even merged yet. I initially bought these guys at $11.80 a share. You can't even see that on the stock price history. I bought it the first day it came out before market close, and I have literally never been down in this company. So if I had help from there, as of right now, we're up over 100%. At the peaks of $31, we were up close to 200%. But if I can get into a company early on, with Lordstown Motors, I got in very early on. It then gave me the option to build my position. So say for example, I had 50 shares, and then I see us go up 50% to $15 a share, and I buy another 50. I'm still going to be up about 25% in that position. So I have room for any considerable pullbacks, but I have a much bigger position. So timing, in my opinion, is important with growth stocks, but regardless of whether it goes up or it goes down, you can have that work to your advantage either way. So don't be afraid if it goes up really quickly and you feel like you've missed out, or if it goes down really quickly and you get scared. If you believe in the company, you know, that's a good buying opportunity either way, in my opinion. Now, it gets a little bit more complicated when you're looking at 30s and you're looking at 25s, but in the early stages of it, yeah, happy days. When you're investing in a growth stock, in my opinion, you need to do an immense amount of research to have a great understanding of that company. Much more research than you have to do into any blue chip or into any dividend stock. If you want to research Facebook, it's easy. I mean, look at the 10Qs, look at the 10Ks, look at the balance sheets, look at the cash position, look at your asset to liabilities. It's so easy. Look at the last few quarters, look at the last few years, look at the 6-month stock chart, look at the 5-year stock chart, look at Facebook's user growth. You have so much information to work with. I mean, a disgusting amount of information to work with. It is so easy. Workhorse. Let's keep in mind, I was trying to find out everything there possibly was to know about this company as early as back here, you know, the start of July. I wasn't one of the fortunate people who was getting in here. I wasn't one of the people who got in really early. I made my first Workhorse video on the 4th of July, and since then, a day has not passed where I have not looked at something to do with Workhorse. That is genuinely the kind of commitment I believe it takes to get into really good growth stocks. But I mean, with Workhorse, you can't go off their quarterly earnings, you can't go off their 10Ks, their 10Qs. You don't have all of this information at your fingertips. You really have to read between the lines. We have an investor presentation, and that was the biggest piece of information we had to get started. And then from there, I go look into data, okay? I look into the CEO, I look into the CFO, I look into Steve Burns, I look into Lordstown Motors, I look into Workhorse since they were a company in 1998. I look into the EV industry, I look into the last mile delivery, I look into Tesla, I look into Rivian, I look into Nikola, I look into every major competitor I can physically find on the internet to understand what sets this company apart from the rest. Why should these guys get my money and not another company? It's not handed to you on a plate with growth stocks. We are trying to invest in companies at a relatively early stage of their life cycle before growth really begins to happen. We don't have years of growth history. In fact, most of the time we have the opposite. We have years of losses. We have bad quarterly reports. We have very poor sales. We don't have the most relationships. You have to figure out why that's going to change, and that's what makes valuating and researching growth stocks so much more difficult, in my opinion, than dividend stocks or even value stocks. But you need to keep up to date with everything. One piece of news you miss out on, you'll open up your app one day and you're either up or down 50% and you are wondering what is going on. With growth stocks, it's not handed to you on a silver platter. You have to go and do the dirty work. And I think that's one of the things I actually love about it. I know it's not for everyone, but I mean, if you give me a blue chip company, I could form an opinion on them within probably an hour and a half. If you give me a growth stock, especially if it's in an industry I don't understand, you're gonna have to give me a week or 2 weeks. Really is that simple. So that's the other thing. You just really need to keep up to date with your stocks. And so this definitely isn't for the passive investor. This definitely isn't for your dividend investor. If you want to just invest and forget about your money, growth stocks are not for you, my friend. Now, the next thing I want to say is, it's okay to sell, and it's okay if you get it wrong sometimes. Let me give you a few examples of companies I've very recently invested in. So CCXX, merging with Multiplan. Now, I don't think I've gotten this one wrong, but I just want to show you a couple of things. Monthly chart, yet again, I bought at literal all-time highs, $11.35 a share, and so I'm down about 12%. This is a SPAC, and it's trading below $10 a share. The merger is set to happen next week. Okay, and if something doesn't happen there, if market sentiment doesn't change, if we somehow continue to trade lower, I would probably say that I got it wrong in the short term, and I would make people aware of that. And I would say, you know, if you're not willing to sit on dead money for a while, if you think your money could be working harder for you somewhere else, maybe it's an okay idea to sell. You're going to take a little bit of a loss. That's going to happen with growth stocks. So another example would be ChargePoint. You can see that once the merger was announced, we shot up 36%. They then proceeded to sell off 14%. We then shot up again. But the interesting thing about this was, okay, a lot of us invested before the merger was even definitive. A lot of us invested here at $14 a share. If the merger never became definitive, we would have all lost money. It would have gone down to $10 a share. You would have gotten it wrong, and it would have been perfectly fine to sell. And I want to stress that because I feel like there's a stigma around selling stocks and admitting you got something wrong. You're going to get it wrong. I mean, the best investors in the world get it wrong. Warren Buffett sold all of his airlines, what, a week before they all went up pretty much 100%? If Warren Buffett's going to do that and his whole team, who is worth literal billions, you, an investor who's probably playing with thousands, you're gonna get it wrong. There's no shame in that. It's absolutely fine. That's how the market works. Stocks don't only go up. So if you're investing in speculative plays, okay, that you think are gonna turn into fruity growth stocks, such as SBE was, for example, before the merger was definitive. If what you're banking on happens doesn't happen, you don't need to be ignorant. You can sell it and you can move on with your life and get to finding the next play. See guys, I think there's a couple of ways to play growth stocks. There's the very degenerate way, which is what I personally believe to be the wrong way. And it's just going all in, it's not having any cash on the side, it's doing a little bit of research, it's following the hype. And sometimes that works out extremely well and you'll make so much money, but sometimes it works out horrifically and you can lose so much capital. I mean, one of the clearest examples I could possibly show you guys would be Nikola. This was all hype, literal nothing but hype. And so, you know, there was people who saw this jump. I mean, in a day up 100%. A lot of people panic bought here without a doubt in my mind. Nikola went up over $90 a share. As of right now, it's at $24.25. If you're too ignorant to admit that you got something wrong, if you didn't cut your losses at say 20%, you're now down, what, 60, 70+%? So that's the first kind. I think it's just people who purely play momentum and hype, and I don't think that's what growth stocks should be. And then there's the kind I tried to showcase today. You remain cash heavy, so that regardless of what happens, you're okay. You can buy more, you can sell at a loss, it's not going to hurt your overall position. You're fine. You only invest in what you understand, you know? You don't need to have every piece of the pie. That's why I'm so invested in EV. I started to realize, you know, you're not going to be an expert in every industry. It's impossible as one person. And I'm willing to admit that, you know. As I said, I don't know enough about these cloud computing services. I missed out on a lot of money because of that. But since I put so much time and effort into EV, I am able to form a fairly good opinion of all new EV related companies and whether or not I think they're a good investment. And so far, every single one of them has worked up well. I've been up over 50% in every single one of my EV investments, except for ChargePoint, but that is literally a 5-day-old investment maybe. You remain calm, cool and collected. Regardless of whether your stock goes up or down, you have a plan, you continue to build your position or you hold your position. You manage your risk and you manage your reward. You keep up to date, and before investing you do an immense amount of research. And then once you are invested, you keep up to date with that company because it's so important. And you understand there is no shame in selling. It's okay if you sell at the top and take profits, and it's okay if you sell at a loss. It's fine. There is zero shame in it. Selling at the end of the day is just as big a part of investing as buying is. That's how you get the money. And I mean, there's growth stock investors, there's short-term growth stock investors, there's long-term growth stock investors. And I think pretty much all of these points goes for each one of those subcategories as well. But guys, there's some tips on how I believe you can become a better growth stock investor. So my friends, there we have it. I do really hope you enjoyed this video and it was able to give you some value and insight. If you did enjoy and you did take something away from this video, can I please ask you to hit that like button, drop me a comment and subscribe if you're new around here, because all of that genuinely helps me and the channel out so much. I really would appreciate you. And if you are interested in joining a community of over 350 investors, a lot of which are primarily growth stock, but we also have dividend and value players. We even have some option guys, some day trading guys. Hit that first link in my description and sign up to become a Patreon. You will get full access to my private Discord server and you will have all of us at your disposal. It's an awesome community. But anyway guys, I think we all owe it to ourselves to always be trying to improve our skills as investors and always be getting smarter and hopefully making more informed plays. And keep in mind, I'm not a financial advisor. These are just my personal thoughts and opinions. This is what I've found to work for me so far. But anyway guys, I appreciate you so much for watching. If you have watched until the end, you are a true legend. I will see you for another video very soon. Have a good day. Peace.